Today is Saturday, April 25, 2026, and the stock market is currently closed. BigBear.ai, trading under the ticker BBAI, ended the most recent trading session on Friday, April 24, at a price of $3.84 per share. This represented a modest gain of 1.32% for the day, with the stock oscillating between an intraday low of $3.61 and a high of $3.83 during the session. While that minor green flicker might suggest a moment of calm, the reality underneath the surface is far more volatile. Most investors see a small-cap AI firm struggling to find its footing after a massive 26% slide earlier in the year. But here is the piece of the puzzle that many are missing. While the retail crowd focuses on the shrinking revenue from legacy Army contracts, the institutional smart money is quietly eyeing a massive $462 million cash war chest that BigBear.ai has built up. For a company with a market cap of around $1.76 billion, having nearly $500 million in liquid strength is a massive pivot that fundamentally changes the risk profile. The common narrative you will hear on social media or basic investing sites is that BigBear.ai is a falling knife because its fourth quarter revenue dropped nearly 38% compared to the previous year. People look at that and see a company losing its grip on the national security sector. However, the contrarian view is that we are witnessing a deliberate, painful, and necessary clearing of the decks. By settling over $180 million in debt early this year and cleaning up their capital structure, management has essentially reset the clock. They aren't just trying to survive the current market, they are positioned to buy their way into the next phase of the industry. This is why tools like the Robinhood app or SoFi Invest show such high retail interest even during price dips. Investors are gambling on the idea that BigBear.ai is no longer just a service provider, but an aggregator of specialized AI tech, evidenced by their recent acquisitions of Ask Sage and CargoSeer. When we look at the recent stock movement, the action has been intense. We saw the price take a 6.4% hit just a couple of days ago on heavy volume, only to see a slow, grinding recovery toward the $3.84 level. This suggests a tug-of-war between short sellers who think the upcoming May 5th earnings report will be a disaster and long-term holders who believe the bottom is finally in. Institutional activity tells a story of cautious accumulation. We've seen firms like Root Financial and CWM LLC increasing their positions by triple-digit percentages recently. They aren't doing this because they love the current losses. They're doing it because BigBear.ai is trading at a forward price-to-sales ratio that looks like a bargain compared to the sky-high valuations of something like Nvidia stock or even some of the more established names you'd find in a Schwab Intelligent Portfolio setup. If you are using a Fidelity trading platform or checking your individual brokerage account today, you'll notice that BigBear.ai has a beta of 3.47. That is incredibly high. It means for every 1% the S&P 500 moves, BBAI is likely to move nearly 3.5%. This is not a stock for the faint of heart or for someone looking for the steady stability of Fidelity ETFs or Fidelity mutual funds. It's a high-stakes play on the intersection of agentic AI and government contracting. The tension here is between the expectation of continued revenue decay and the reality of a company that has successfully reduced its debt by 90% in a single year. Most companies in this position would be facing a liquidity crisis, but BigBear.ai has somehow come out the other side with more cash than it has ever had. This gives them the freedom to fail on small projects while swinging for the fences on massive new federal AI modernization contracts. Now, let's talk about the business itself, because the stock price is just the scoreboard for the underlying machine. BigBear.ai operates in the high-pressure world of national security and logistics. They provide the brains that help military and commercial leaders make sense of massive, chaotic datasets. Think of it as a decision support layer that sits on top of existing infrastructure. Their recent acquisition of Ask Sage is a perfect example. It's a generative AI platform specifically designed for regulated, secure environments where you can't just use a public chatbot. This is their moat. While every big tech company is fighting for the consumer market, BigBear.ai is entrenching itself in the world of clearance-required AI. They're moving into the Middle East market and expanding into cargo inspection at ports, which are sectors that don't care about the latest viral AI trend, but care deeply about security and accuracy. Historically, this company has been a victim of its own SPAC-era baggage. Like many companies that went public via a merger around 2021, it carried a lot of debt and had a complex web of warrants and convertible notes that made the balance sheet look like a nightmare. The market punished them for it. For the last 2 years, the story was one of non-cash losses and derivative liabilities. But as of early 2026, that baggage is mostly gone. They've moved from a defensive posture to an offensive one. When you see names like Interactive Brokers or Fidelity showing a hold rating, it's because the analysts are waiting to see if that $135 million to $165 million revenue guidance for the full year 2026 actually materializes. They want proof that the acquisition of CargoSeer wasn't just a way to hide declining organic growth. If you're the type of investor who manages their own money through online investing or looks for investment help on various investing sites, you have to weigh the macroeconomic pressures against this micro-level turnaround. High interest rates have historically crushed small-cap tech, but since BigBear.ai has virtually wiped out its debt, they are much less sensitive to the Fed's whims than they were 12 months ago. This makes them an outlier in the small-cap AI space. They're competing with giants like Palantir and C3.ai, both of which have much larger sales teams and deeper pockets. But BigBear.ai's smaller size allows it to be more agile in niche defense contracts that might be too small for Palantir to bother with, but too complex for a general software provider. The reality of the situation is that BigBear.ai is currently a show-me stock. The expectation is that the May 5th earnings call will show another revenue miss because of delays in Army program volumes. If the reality is even slightly better, say a flat revenue line but improved gross margins, the stock could see a massive short squeeze. We've seen this pattern before in the AI sector. Investors who use the Robinhood app for Robinhood fractional shares often jump on these momentum swings, which can drive the price up 20 or 30% in a single week. Conversely, if the revenue continues to crater and the cash burn accelerates, that $462 million cushion will start to look a lot smaller to the institutional players who are currently providing the floor for the stock price. Before we move into the final outlook, I want to hear from you. Comment below how many shares of BigBear.ai you currently hold, or if you are waiting for the price to drop below the $3 mark before you consider an entry. Also let me know, do you think the government's focus on AI safety will help or hurt smaller defense contractors like BBAI in the long run? Engaging with the community is how we refine these theses, so don't be shy with your take on the current price action. Looking toward the future, the outlook for BigBear.ai is a classic high-risk, high-reward scenario. The catalysts are clear: the May 5th earnings report, the potential for new contract wins in the Middle East, and the integration of their new AI platforms. The risks are equally clear: execution risk on the new acquisitions, and the potential for further delays in government procurement cycles. If they can hit the midpoint of their revenue guidance, roughly $150 million, it would represent a 17% growth rate. In a market where Tesla stock or Apple stock might struggle to find double-digit growth, a 17% jump for a company at this valuation would be significant. However, the market is currently pricing in the expectation of a struggle, which is why the stock remains under $4 despite the massive cash position. To summarize the central insights, BigBear.ai is currently in a state of extreme transition. The expectation among the general public is that this is a struggling defense contractor losing its core business. The reality, however, is a company that has used the last year to aggressively repair its balance sheet, eliminate debt, and build a massive liquidity reserve that it is now using to acquire specialized AI assets. This creates a massive gap between public perception and the company's actual financial health. Whether you are using SoFi Active Investing, Interactive Brokers, or a Fidelity brokerage account, the key to BigBear.ai is watching the margin expansion. If they can turn that cash into profitable growth, the reality will eventually force the market to revalue the stock. For now, it remains a volatile, high-conviction play that requires a deep understanding of the national security tech landscape. The authority in this trade doesn't come from following the daily price swings, but from understanding that a company with $500 million in cash and no debt is rarely as weak as its stock chart might suggest. We've looked at the institutional activity, the debt reduction, and the strategic acquisitions. Now, the ball is in management's court to prove they can execute on their 2026 guidance. Stay grounded, stay informed, and always look for the gap between what the market expects and what the balance sheet reveals. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, outshare with your friends, bell subscribe for more updates.